Welcome to the third installment of our Advanced Tax Strategies for Estate Planning series. In this video, we'll dive into the sophisticated world of estate freezing techniques, a powerful method used by high net worth individuals to preserve and transfer wealth efficiently. Estate freezing is a strategic approach designed to lock in the current value of your assets for tax purposes while allowing future appreciation to benefit the next generation. By understanding and implementing these advanced strategies, you can significantly reduce your estate tax liabilities and ensure a smoother transfer of assets to your heirs. Let's explore some of the most effective estate freezing techniques and how they can help you protect and pass on your wealth. Exploring estate freezing strategies. Estate freezing is a common technique used in estate planning to lock in the current value of an individual's assets for tax purposes, while transferring future appreciation to the next generation. This strategy is particularly useful for high net worth individuals who wish to minimize estate tax liabilities and ensure a smooth transfer of wealth to their heirs. There are several estate freezing strategies that individuals can consider, each with its own advantages and considerations. Some of the most commonly used estate freezing strategies include the following. 1. Family trusts. Setting up a family trust allows individuals to transfer ownership of their assets to the trust, effectively freezing the value of those assets for estate tax purposes. By naming their heirs as beneficiaries of the trust, individuals can ensure that the future appreciation of the assets will accrue to their heirs, rather than being subject to estate taxes. 2. Gifts of appreciating assets. One simple estate freezing strategy involves gifting appreciating assets to heirs or trusts. By transferring ownership of assets that are likely to increase in value over time, individuals can remove the future appreciation from their taxable estate, thereby reducing their estate tax liability. Grantor retained annuity trusts, GRATs. A GRAT is a type of irrevocable trust that allows individuals to transfer assets to their heirs while retaining an annuity payment for a specified period. By using a GRAT, individuals can freeze the value of the transferred assets for estate tax purposes, potentially reducing the overall estate tax liability. 4. Sale to intentionally defective Grantor trust, IDGT. In this strategy, individuals sell appreciating assets to an IDGT in exchange for a promissory note. Since the trust is considered defective for income tax purposes, the sale is not recognized for income tax purposes, allowing the assets to grow outside of the individual's estate. 5. Preferred partnership freezing. By transferring assets to a family limited partnership or limited liability company, LLC, individuals can freeze the value of those assets for estate tax purposes. By gifting or selling partnership interests to heirs, individuals can transfer future appreciation to their heirs, while retaining control over the assets during their lifetime. Exploring estate freezing strategies is essential for individuals looking to minimize estate tax liabilities and ensure a smooth transfer of wealth to their heirs. By utilizing techniques such as family trusts, gifts of appreciating assets, GRATs, IDGTs, and preferred partnership freezing, individuals can effectively lock in the current value of their assets while transferring future appreciation to the next generation. It is important for individuals to work closely with their tax and estate planning advisors to determine the most appropriate estate freezing strategies based on their individual circumstances and goals. Intergenerational wealth transfer techniques. Intergenerational wealth transfer is a key aspect of estate planning, allowing individuals to pass on assets and financial resources to the next generation while minimizing tax implications and ensuring the efficient distribution of wealth. Various techniques can be employed to facilitate the transfer of wealth from one generation to the next, each with its own benefits and considerations. 1. Lifetime gifting. One of the most common techniques for transferring wealth between generations is through lifetime gifting. By gifting assets during one's lifetime, individuals can reduce the size of their taxable estate, potentially lowering estate tax liabilities for their heirs. Annual gift tax exclusions and lifetime gift tax exemptions can be leveraged to maximize the amount that can be gifted tax-free. Grantor retained annuity trusts, GRATs. A GRAT is a trust that allows an individual to transfer assets to beneficiaries while retaining an annuity payment for a specified term. At the end of the term, any remaining assets in the trust pass to the beneficiaries free of gift tax. GRATs can be an effective way to transfer wealth to the next generation with minimal tax consequences, especially if the assets in the trust appreciate over time. C. Family limited partnerships, FLPs. FLPs are a popular estate planning tool that allows families to pool assets into a partnership structure. with the senior generation retaining control as general partners and younger generations as limited partners. This structure can facilitate intergenerational wealth transfer by allowing assets to be transferred to younger family members at a reduced gift tax value, while also providing asset protection and centralized management benefits. 4. Irrevocable life insurance trusts, ILITs. ILITs are trusts specifically designed to hold life insurance policies outside of an individual's taxable estate. By placing life insurance policies within an ILIT, the death benefit can be passed on to beneficiaries free of estate tax, providing a tax-efficient way to transfer wealth to the next generation. 5. Generation skipping trusts. Generation skipping trusts are designed to transfer assets to grandchildren or more remote descendants while skipping a generation, such as the children. This can help minimize estate taxes that would otherwise be incurred in each successive generation. Generation skipping trusts can be complex to set up and administer, but they offer significant tax savings benefits for families looking to preserve wealth for future generations. Intergenerational wealth transfer techniques play a crucial role in estate planning, enabling individuals to pass on their assets and financial resources to successive generations in a tax-efficient manner. By leveraging various strategies such as lifetime gifting, GRATs, FLPs, ILITs, and generation skipping trusts, individuals can effectively manage their estates and ensure a smooth transfer of wealth to their heirs, while minimizing tax implications. It is essential to work closely with experienced estate planning professionals and tax advisors to tailor these techniques to individual circumstances and goals. So, valuation discounts and their impact on estate taxes. Valuation discounts play a crucial role in estate planning, particularly in minimizing estate tax liabilities. These discounts allow the estate to be valued at an amount lower than its fair market value, thus reducing the taxable value of the assets. One common strategy used to achieve valuation discounts is through the application of minority interest and lack of marketability discounts. Minority interest discount. This discount reflects the reduced value of a partial ownership interest in a business or asset compared to the value of the entire interest. When an individual holds a minority stake in a closely held business, they may not have control over key decisions or be able to easily liquidate their ownership. As a result, the value of the minority interest is discounted to reflect these limitations. This discount can significantly reduce the taxable value of the estate, as the IRS recognizes the diminished control and marketability of minority interests. Full lack of marketability discount. Assets that are not easily marketable or liquid, such as closely held businesses, real estate, or artwork, may also qualify for a lack of marketability discount. This discount accounts for the fact that these assets may take longer to sell and may require a discount to attract buyers due to their illiquidity. By applying a lack of marketability discount, the taxable value of these assets can be reduced, resulting in lower estate tax liabilities. Combined impact on estate taxes. By leveraging both minority interest and lack of marketability discounts, estate planners can significantly reduce the taxable value of an estate. When these discounts are properly justified and supported by valuation experts, they can result in substantial tax savings for the estate and its beneficiaries. However, it is essential to comply with IRS regulations and guidelines to ensure that the valuation discounts are legitimate and defensible in the event of an audit. Valuation discounts such as minority interest and lack of marketability discounts are powerful tools in estate planning for reducing estate tax liabilities. By carefully applying these discounts and seeking professional guidance from tax and valuation experts, individuals can optimize their estate plans to maximize tax savings and preserve wealth for future generations. Structuring family limited partnerships and LLCs for tax efficiency. Structuring family limited partnerships, FLPs, and limited liability companies, LLCs, for tax efficiency can be a powerful strategy in estate planning. By utilizing these entities, families can achieve significant tax benefits and asset protection. Structuring family limited partnerships and LLCs for tax efficiency. Family limited partnerships, FLPs, and limited liability companies, LLCs, are popular choices for structuring assets in a tax-efficient manner. These entities are commonly used to hold family businesses, real estate, investments, and other assets. Properly structured FLPs and LLCs can offer several tax advantages, including estate tax savings, income tax benefits, and asset protection. 1. Estate tax savings. One of the primary benefits of using FLPs and LLCs in estate planning is the ability to transfer assets to the next generation at a reduced tax cost. By gifting or selling partnership interests or membership interest in the entity, the senior generation can gradually transfer ownership to younger family members, while taking advantage of valuation discounts. These discounts are typically applied due to restrictions on marketability and lack of control associated with owning a minority interest in the entity. As a result, the transferred assets are valued at a lower amount for gift and estate tax purposes, potentially reducing the overall tax liability. 2. Income tax benefits. FLPs and LLCs offer flexibility in income tax planning. These entities are typically treated as pass-through entities for tax purposes, meaning that profits and losses flow through to the individual partners or members. By allocating income and deductions strategically among family members, it is possible to achieve tax savings. For example, income can be distributed to family members in lower tax brackets, reducing the overall tax burden on the family as a whole. Additionally, FLPs and LLCs can provide opportunities for income splitting, allowing family members to benefit from income generated by the entity. Asset protection. In addition to tax benefits, FLPs and LLCs can also offer asset protection advantages. By holding assets within a separate legal entity, individuals can shield those assets from creditors and potential legal claims. This can be particularly valuable for protecting family wealth from risks such as lawsuits, bankruptcy, or divorce. Assets held within an FLP or LLC may be more difficult for creditors to access, as they are considered separate from the personal assets of the individual partners or members. When structuring FLPs and LLCs for tax efficiency, it is important to work closely with experienced legal and tax advisors. Proper formation and ongoing maintenance of these entities are critical to ensure compliance with relevant laws and regulations. Additionally, careful consideration should be given to the specific goals and circumstances of the family in order to tailor the structure to meet their needs effectively. Structuring family limited partnerships and LLCs for tax efficiency can be a valuable strategy in estate planning. By leveraging the tax advantages, income tax benefits, and asset protection features of these entities, families can optimize their wealth management and succession planning goals. In conclusion, advanced estate freezing techniques offer powerful tools for high net worth individuals looking to minimize estate tax liabilities and ensure the seamless transfer of wealth to future generations. By leveraging strategies such as family trusts, gifts of appreciating assets, GRATs, IDGTs, and preferred partnership freezing, you can effectively lock in the current value of your assets while transferring future appreciation to your heirs. These methods not only help preserve your wealth, but also provide significant tax advantages. As always, it's essential to work closely with experienced tax and estate planning advisors to tailor these strategies to your unique circumstances and goals. Implementing the right estate planning techniques can make a substantial difference in securing your financial legacy for generations to come. Thank you for joining us in this video, and be sure to stay tuned for more insights and strategies in our ongoing series on advanced tax planning for estate management.